You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, welcome to another episode of Real Estate Runway Podcast, special Chad's Soapbox edition. Today, we are going to talk about a very interesting topic about why cap rates in multifamily are going to sub 4% across the board and why they're going to stay there. This is a Chad's Soapbox, Chad's Opinion Day, as I promised would start coming every other week. So why do I think this? Okay, there's a lot of discussion out there in the news. I mean, we see inflation. It's, I think, as of the latest report, depending what you include in the basket of consumer price index or CPI goods, we're at about 7.5%. If you peel out groceries and fuel, we're at 6%. So there's that. Okay, we're sitting here in the wake of quantitative easing from the pandemic as that's phasing out, and with current threats from the Fed of rising interest rates to try to curb this pesky inflationary time that we're seeing. So why do I think that cap rates on multifamily properties are going to go sub 4% and stay there? I think I'm in agreement with my friend Neil Bawa, who has also been talking about this. But let's talk about the reasons why that is. Okay, the first is supply and demand. The second is tokenization of real estate. The third is interest rates. The fourth is the effect of quantitative easing. And then we're going to talk about something no one's really thinking about if you look ahead through the periscope of the assumption loan market. So overall, I do believe, cut that out, please. Overall, I do believe that the cost per door will rise on real estate in general, and specifically multifamily. So why is all that? Let's talk about supply and demand, okay? You've heard me preach about this time and time and time again. Since the Great Recession, we have not built enough housing of any kind to keep up with the demand and the creation of households. So we have been in a very large expansion market. What happens when we're in an expansion market for the last 10 plus years, right? People that were living together go get their own place because they can afford to. So households are created. Okay. So if we go into a recessionary time, sure, you will see people moving back in with each other. That will probably, continue to exist in the blue collar and more affordable workforce housing realm. But supply and demand, nonetheless, is still a massive problem. We have built, on average, I want to say it's about 65% of what is actually needed if you look at the overall starts and deliveries throughout the last cycle. So that's why we're still seeing rental rates rise despite the pandemic that we've gone through. You still see lots of capital flocking to this space. Over $100 billion, I think, is what is seeking multifamily assets right now because of a couple of things. I mean, real estate is being treated like gold. And when I say like gold, I mean, when there is uncertainty in the market, money leaves securities and goes to gold because it holds purchasing power. That's how real estate is being treated, because rental rates tend to rise with inflation. We'll get to that, back to that in a second. But overall, supply and demand, we're really in a time where we have an abundance of household formations. The baby boomer generation. I was just talking to a gentleman the other day who sprays the pest control spray around my house. He was just bragging to me how much money he made for his single family home that he's lived in for 35 years. It needs a bunch of upgrades. And he's like, I can't get my head around buying something right now. I just can't do it. So what did we do? We went and rented a Class A apartment. We're loving it. We don't have lawn care. It's a lock, key, and leave mentality. That is really becoming prevalent. People want freedom. They don't want to be tied down to a mortgage and taxes and insurance and everything like that, and upkeep that goes with it. So the baby boomer generation, as they move into retirement, are becoming largely more renters. Not everybody. That's a generalization statement. Millennials are finally just getting to the point, after living through, some of them, 2 recessions, right? Are just now getting to the point where they're choosing to start families and buy homes. The build for rent nation, okay, is even started, which is basically what a multifamily is, but now we're doing it with single family neighborhoods, right? That's becoming a hot topic because these millennials, they want a house, but they don't want to or can't buy a home, okay? So supply and demand for rental housing is huge. The supply is down, the demand is high, and it will be for years to come. I don't care if we see reduction in households, we don't have enough product out there. So reason number one, that cap rates are going to sub 4% and will stay there. Reason number two, tokenization of real estate. What does that mean? We've all heard of this concept of cryptocurrency and blockchain. And while I'm not an expert on that, I do recognize that blockchain is basically like a transaction register, right? That's my very simple definition of it. Is it's a piece of, every time a transaction happens, a piece of code is linked to this chain, and it kind of has all the previous owners and the transaction history, right? Well, this technology is starting to be used by companies like Token, who are getting ready to launch a marketplace for tradable real estate investments. Think about what that means. Real estate has typically been an illiquid asset. I mean, yes, you can buy and sell it, but it's not like a stock where you say, "Oh man, the futures are up today or futures are down today. I'm going to go trade, my GE stock for Apple or whatever it is." So what does that mean for us? That means that sponsors like Quattro, or, for example, or like Grow Capitus, or anyone out there who is doing these larger real estate deals and sourcing equity from the private equity market from investors, they can now list their deal on this marketplace. What does that marketplace do? It is a place kind of like this crowdfunding idea where you can go on crowdfund or CrowdStreet and go out there and put $5,000 or $10,000, much smaller than the typical investment amount, into a piece of real estate, right? So that's that concept of crowdfunding, of sourcing equity from a whole lot of people is very new and newly legal with regards to what the SEC shows, or where the SEC stands on this. Tokenization of real estate will now say that, okay, these deals can be listed in this marketplace, and it'll almost be kind of like a REIT, but not like a REIT, to where these private offerings can now be sold. The shares to this can be sold on this marketplace. And the problem is now, you're letting in a threshold of very, very low threshold of capital, which, I hate to say it this way, but the smaller the capital check, not always, okay, there are many smart people out there, but if you start, accepting checks in the $100 to $500 range, or a couple $1,000, there's not enough diligence that goes into that investment. So you're going to start seeing investors, oh yeah, I'll throw, it's kind of like we do with crypto, right? I'll throw $500 in crypto, see what happens. I'll throw $500 in real estate, see what happens. And if I like how it's going, I'll keep it there. And if I don't, I can now trade it just like I do a stock. So it makes real estate liquid, So typically when you invest in a private real estate offering, like an apartment building, you're in that project for the duration until it sells or refinance. You can't really, from a position that's beneficial to you, sell that share. So what does that mean? What happens when you can do that? The way it's going to manifest itself, I do believe, is you're going to see an increase in pricing. And why is that? Because pricing is commensurate with the cost of capital. All right. We can talk about value and NOI and all that kind of stuff, but I've seen too many deals. Pricing goes with the cost of capital. Okay. Interest rates, that's why we talk about interest rates and cap rates having that relationship, right? Where if interest rates rise, cap rates go up as well to a point. It's not the only factor, but if the cost of borrowing goes up, well, gee, I can't pay quite as much for that piece of property, right? The same thing happens in the single family market. Now let's think about the equity. For those who are syndicating their equity from investors, if the cost of equity goes up, let's say it's 30%, well, I can't afford to pay as much for that building as I would, because, you're not going to have enough to pay everybody. You'd be working for free. Whereas if the cost of capital goes down, okay, so let's say the interest rates stay reasonably affordable, and now your cost of capital goes from 15 or 20% down to 5, right? Well, now we start competing with large institutional players, and that those prices just keep bidding up. So that's another force that I believe, no one's really talking about this, but I believe it will drive cap rates to further compress when tokenization of real estate becomes a real thing. Now let's talk about interest rates. Okay, so we have supply and demand and tokenization of real estate. Interest rates, why do they matter? We just mentioned that interest rates have somewhat of a correlation with cap rate. It is not the only thing, right? We've seen interest rates rise and fall a little bit, and the cap rate remain relatively unaffected throughout the pandemic. So supply and demand also plays a lot. The amount of capital seeking these assets also plays a lot of a big role in pricing for these real estate assets, being multifamily. But interest rates, we're talking about the Fed increasing the interest rate, which will increase the cost of borrowing. Okay. They're also talking about removing, removing the quantitative easing measures that were put in place during the pandemic. What most people don't know is the Fed is, and has been for a long time, the largest buyer of 10-year Treasury bills. 10-year Treasury bills are what drive the loan market in the secondary loan market in real estate. So if I go get a loan from Fannie or Freddie Mac, they don't sit on that loan. They sell it to the secondary market at a rate relative to the 10-year Treasury. So quantitative easing, when that starts pulling back, the Treasury, the Fed is starting to pull back on how many Treasury bills they're buying annually. So that's causing the rates to have to rise a little bit because they have to pay more to get investors to buy those bonds. The Fed is a really cheap investor. So quantitative easing pulling back, I kind of talked about two topics here. Quantitative easing pulling back is also going to affect the interest rates. So that's kind of a subtopic. Back to the interest rates in general, the Fed is talking about increasing interest rates a couple of times this year. Now, when we say, what's the magnitude of that, right? A lot of us who are underwriting multifamily deals, we're talking about, seeing at the end of this, probably about 100 basis point or 1% increase on your rates from where they are today. Whatever loan product you're looking at, look at that going up about 100 basis points over the next 12 months. That might, I think it will have some downward impact on pricing a little bit because of the cost of borrowing. It still doesn't change the overwhelming pressures of supply and demand and tokenization of real estate. So yes, interest rates will affect cap rates in the rising direction, making pricing go down a little bit, I think. But it's not the only thing driving cap rates. So I do believe that quantitative easing and the Fed are going to affect the interest rate up. But I do believe, based on history of previous recessions and what I know of this current Fed leadership currently, is that they're not going to have the cojones to increase rates more than 100 basis points. I just don't see it happening. So I do see, and it may even be a temporary rise, and then they'll fall back down when we get out of the inflationary period to try to, jumpstart growth again. So I see interest rates rising, but kind of remaining relatively flat over the long haul, which doesn't support pricing going down on real estate at all. Assumption loan market. This is another piece of what's been happening with cheap debt on real estate, especially multifamily, that no one's really looking at, but it's going to start hitting us in about, I don't know, the next 3 years, maybe even now. As rates go up, that should be increasing the cost of borrowing on a 100% basis, right? So if rates go up 100% or 100 basis points, then you should see the pricing have a kind of a one-to-one impact on the borrowing cost. Well, I don't think it will. Here's why. There's been a lot of Fannie Mae, Freddie Mac, and Ginnie Mae debt placed on these multifamily assets, long-term loans. Well, guess what? Those 10, 12, 15-year loans, they come with massive prepayment penalties if you were to sell and let a buyer take fresh debt. So the seller has a choice to make, right? Over the next couple of years, when they're selling an asset, they can choose to take the hit and let the buyer go put free and clear debt on it, or they can help the buyer assume the loan. So Fannie Mae, Freddie Mac, Ginnie Mae, they will allow these loans to be assumed by the next buyer. And in some cases, most cases for large assets, you can put a supplemental loan on it. So here's how that works. If interest rates go up 100 basis points, and I've got, so maybe they're 4%, and I've got a loan that I put on this thing 4 years ago that's at 3%, and it's going to cover 60% of the cost of the asset. That's a pretty attractive loan to assume, to take over, because you get the benefit of my rate. Now, this is going to depend on how many years of interest only are still there and all that sort of stuff. So we'll leave that complexity out of it right now. But assuming you have enough interest only to be enticing to the next borrower, they will then go get a secondary or a supplemental loan with the same lender, but it's going to be at today's interest rate and maybe even a little higher. So when you combine that together, maybe you have to get an extra 20% of the purchase price. That combined interest rate is going to be lower than than the current interest rate in your borrowing environment. So that's another situation that is just going to aid on keeping prices down. And overall, with inflation, the last little piece here is cost per door will rise over time. I do not see, even if a correction happens, I really don't see the cost per door dropping of real estate. The dollar may be worth less due to inflation, but rents do keep pace generally with inflation, whether wages do or not. That's the frustrating part. And, we can talk about why that's important in a different episode, but, wages are actually starting to keep up with inflation for the most part. Not as well as we would like, but a lot of to get people to go back to work, we're having to pay them more, right? Which may be the one smart thing the Fed has done in this cycle. So overall, my opinion, I do not see a situation where cap rates will decompress on multifamily real estate for years to come. Will it happen in the future? Sure, it's cyclical. It always does, but there's so many pressures, both artificial and naturally occurring, that are pressing on the price of multifamily real estate. I think we're going to be able to continue to make money for a long time to come. Invest wisely, folks. If it's too good to be true, it probably is. Consider supply and demand in every aspect. Think about the tokenization of real estate. Think about how what we discussed with interest rates and the effect of quantitative easing pulling back on interest rates. Think about how the assumption loan market, will affect net interest rates for buyers in the future. And just remember, with inflation rising, the cost of your real estate is going to continue going up for a time. You will see a correction. It is cyclical. It always happens, but I still see this as a very robust market. I see it as a very robust investment. And quite frankly, I don't see a way that we experience a cap rate decompression anytime soon. Until next time, I'm Chad Sutton, Real Estate Runway Podcast. This has been Chad's Soapbox Special Edition. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.